Joining us now to tell us what moved the markets is independent investment expert and author of Value.able, Roger Montgomery from rogermontgomery.com. Roger, I want to get your opinion, just I suppose on super. Let's focus on the proposed 9% increase to the 9 to 12% increase on the compulsory guarantee. Is that likely, do you think, to have an impact on markets?
Well, I think long term the answer is no. And the reason I believe that is because the money doesn't only go into equities, it goes into other asset classes. And I think people need to be mindful of that. Often various industry leaders and commentators believe that their particular industry is the centre of the universe, but that fails to recognise that there are other centres of universes. And so it's really important to understand that money will be spread around. But it's not going to change the fact that the market will go up and will go down. And the change, of course, to the default fund, I think that's a vast improvement to what people have had the option to invest in. Jeremy Cooper, I think, has proposed a very good solution for those investors that really just aren't interested in stocks and aren't interested in the equity market, don't want to go out and select a fund manager, don't want to pay high fees for their employer to select a fund manager and platforms. So the default fund that's being proposed, which is a low cost option, I think that's a fantastic idea, and I think it'll be very, very helpful, and people will find that over time, as it compounds, there'll be large savings and a large benefit by not paying those additional fees.
Okay. Things, Roger, I want to discuss with you in this regard. Firstly, Santos, where does it rank? Does it rank as one of your
No, it's not
A1s?
an A1. It's definitely not an A1 business. No, it's not. This is what Santos is meant to do. You know, it's meant to find the stuff and it's meant to sell the stuff. So, you know, big deal. You know, it's doing what it's supposed to do. Longer term, you want to buy businesses, and I've talked about this in my book that many of your viewers have purchased. You want to buy businesses that generate very high rates of return on their equity. You want to buy businesses that have little or no debt. You want to buy them when they're at big discounts to their intrinsic value. Santos isn't one of those companies that I would rank very highly, and I think there are other opportunities in that space that maybe aren't as big as Santos and they don't hit the headlines as often, but they're better businesses and offer better investment return potential.
What about some of the companies, the stocks related or exposed to oil? I mean, is oil something that you do like at the moment?
Look, I actually, I'm going to put my head on the block and say that...
That's what we like?
While I don't know whether or not the price of oil will go down to $40 before it goes up, I think we're sleepwalking into an oil shortage crisis. I was doing some reading today and there's a new book that's been brought out by a guy named Defies, I think that's how you pronounce his name. He was the understudy to Hubbert, who came out with Hubbert's Peak and the peak oil theory. He's just written a book called When Oil Peaked. And I thought, well, has oil actually peaked? We should go back and find out. Well, I found out that the Energy Institute, Energy Industry Association in the United States has come out and said global oil production peaked in 2005. The IEA, the International Energy Agency, said that oil peaked in 2006, and the very well-known Platts Oilgram newsletter also concurred that oil peaked in 2006. And here's an interesting thing. The most widely reported reserve journal is the oil and gas, called the Oil and Gas Journal. And what they do is every year they send out a survey to the major oil companies, and they ask them to fill out the survey just to report reserves, global reserves. And it's the most widely watched reserve figure for the oil industry. And what I found out, and what some other analysts have found out, is that if a company doesn't fill in that survey in a particular year, so it's not returned at all, the Oil and Gas Journal just uses the previous year's number and reports that number as the reserve.
It's a bit of a worry.
Look, I'm going to be talking more about oil in Summer Money after this program, but we are walking into a potential oil catastrophe, and if that's the case, the oil price will go up a lot. A company that I really like is a company, and I've talked about it on your show before, Matrix Composite and Engineering.
Yeah.
And it actually manufactures buoyancy devices for deep sea oil rigs, and as the oil price goes up, clearly it's more commercially viable to go and spend the money on deep sea exploration. So I think there's going to be a lot more of that going on in the decades hence.
Coal in general has been a bit of a hot sector. People writing, talking a lot about it. Is it an area that you like?
Let me say this, I think long term demand for Australian coal is assured, and I think it's the right place to be. Having said that, though, it won't be a straight line increase. There'll be stumbles along the way. For example, one potential is the housing bubble bursting in China, and everyone has heard Jim Chanos on that subject now. So I think it will be lumpy, but I think long-term demand for Australian coal is assured. However, when I look at the intrinsic values of our coal companies and I compare them to our prices, almost universally, the prices of our stocks are significantly higher than they are than is justified by the performance of the businesses. And so I would say that the good news, at least for the foreseeable future, is being factored into coal stocks.
To ask you, Roger, what your thoughts on what we've been hearing over the past few days, the Senate inquiry and the Treasurer's reform package?
Yeah, look, I think the reform package isn't really a reform at all. It's a bunch of small measures that will unfortunately hinder, I believe, will actually hinder the smaller lenders. The idea that the credit unions could collectively become a fifth pillar, I think is absurd. They simply don't have the wherewithal or the infrastructure, so that's not going to happen. So I don't think competition's going to increase significantly in Australia. I also believe that the banks collectively are trading on or about their intrinsic value, and I mentioned that earlier. And I think those intrinsic values are rising. This talk about...
So does that mean that you like them as an investment option?
If I could buy them at very, very big discounts to intrinsic value, the answer would be yes, because that would lower my risk significantly. Yeah. My first objective is not to lose money, and the way I do that is a couple of ways. One is to make sure I'm only buying A1 businesses, and I talk about the sorts of things that you should look for in my book. And so we haven't got time to go through all that now. But I also like to buy at big discounts to intrinsic value, and the banks are trading at about their intrinsic value. Those intrinsic values are rising, but if you want to be certain of a really good return rather than hopeful of a good return, then you want to buy at big discounts to intrinsic value. So you've got to calculate the intrinsic value and then wait for the price to be a lot lower. That's not the case now. The whinging that I'm hearing from the banks saying, oh, it's unfair and our funding costs are going up, it's true. The funding costs are going up. But you're raising rates above the RBA rates. You're raising them to defend profit growth. So if you want to be certain of profit growth, then you're doing it. They're already making $22 billion in profit collectively. Arguably, that's a lot. So you know, they're trying to. What they're doing is they're saying, look, in order for us to continue growing our profits, we have to do these things. They're not saying, oh, you know, our funding costs are going up and it's really hard because, hey, you know, you just made $6 billion profit.
Yeah, it's a hard argument to make. It's an interesting one. Just quickly, Roger,
Sure.
Thoughts? What do you think?
I was trying to think of an analogy about this particular deal. And imagine you have two baths that are completely full of water, and one's AXA and one's AMP, and they're a long distance apart geographically. You can bring them closer together and bring them side by side, and then you need less taps and less pipes and, you know, less hosing, and you can save some money there. But once you've saved that money, then what happens next? All that you get is the result of paying too much for that second bath. And if you pay too much, then your return on equity drops and the business is actually worth less, not worth more. You might get profit growth, but your return on equity drops. And what I know in my experience is that price over long periods of time tends to follow return on equity rather than profit growth. Classic example was ABC Learning Centre. Its profit went up over several years, but its return on equity was declining, and that's ultimately where the share price went.
Okay.